Chapter 2, Part 3, Preparing the Trial Balance. Now, we've already gone through what a financial transaction is, what an account is, the types of accounts, what is a debit or credit. We went through the double entry accounting and recording financial transactions. This is what goes on. The recording of financial transactions goes on all month, and then at the end of the month, we do what we call a trial balance. Now, one of the things we do when we prepare the trial balance is we want to make sure that the accounts all have the normal balance, which is the side that increases it. If the balance is not normal, it indicates a negative amount. So examples of our journal entries from Part 1, and we journalized those and posted them. And this is what our general ledger using T accounts from Part 2 looks like. And now what we're going to do is put these in the format of a trial balance. Now, a trial balance, the first one, which is called the unadjusted trial balance, is a list of all accounts and their balances at a particular date showing that total debits equal total credits. What you're doing is you're trying to make sure that all accounts have their normal balances and the debits total the credits, because remember, we have to be in balance. There are 3 trial balances that are prepared at different points of the operating cycle. The one we're looking at today is the unadjusted trial balance. It is the first one prepared at the end of the period. This trial balance we're going to use to make sure debits and credits equal, our balances are normal, and to see if we have to make any adjustments. Have we earned any income? Have we incurred any expenses that were not recorded during the month? Then we prepare an adjusted trial balance. This is prepared after we do adjusting entries, and it is the only one that we can use to prepare the financials with. So remember, you can only prepare the financial statements with an adjusted trial balance. And then the post-closing trial balance is only done at the end of the year after we close our books. We're going to cover the last 2, adjusted trial balance and post-closing trial balance, in Chapter 3. Now, these are used for internal purposes only. They're not published to external parties, not required to follow an order of listing. First of all, we're going to add up all the balances at the end of the month. Remember, add up the debits and the credits, then subtract the debits from the credits. This first trial balance shows if debits equal credits, all accounts have normal balances, and it helps us find errors because we can look, does any account have unusual activity? So we've gone through, we've added up all our accounts. The accounts payable, we had debits minus the credit, means we've got a credit balance of $10,000. We added up our cash, we added up all our debits and all our credits, and we subtracted our debits from our credits, and we end up with a debit balance, which is the normal balance, which is good. And we did the same thing for sales. Now we can prepare our trial balance. We list assets based on conversion to cash, liquidity. So we start with cash, accounts receivable, office supplies, equipment. Then we would list our liabilities. Accounts payable, deferred revenue, notes payable. Then we would show our equity. We show our common stock, our dividends. And then we would show our revenue and expense accounts. Now we add them up, our debits equal our credits. Now look at the way this works. When we list them like this, here is our income statement, which is revenue minus expenses. That's our statement of stockholders' equity, which is common stock, minus dividends, plus income. Our balance sheet is our assets and our liabilities. So let's go through an example. Here's all this information, and we're going to do a trial balance. So what we're going to do first, we're going to look to see our most liquid, which is cash. We list that first, and then we would go on and look at all of our asset accounts. Then we would look at our liability accounts, which includes deferred. Remember, deferred revenue is not revenue. It's revenue that we haven't earned yet, so it's a liability. Common mistake that students make. Then we'd list our common stock, our retained earnings, our revenue, our salary expense, our utilities, and then we total them up. And again, the debits equal the credits, so we know we're okay, and everybody has their normal account. All of our assets have debit balances. All of our liabilities, common stock, retained earnings have credit balances along with revenue, and our expense accounts have debit balances, so we're okay. Now let's explain what makes up retained earnings. The balance in retained earnings reflect prior year net income or losses less any dividends. Revenue, expense, and dividends are only shown for the current year. Their balance are transferred to the retained earnings at the end of the year. We covered that in Chapter 3. Net income increases, net loss decreases it, along with dividends. So, for retained earnings, we always start with that beginning balance. We then add net income or subtract net loss, subtract dividends, and that's how we get our ending balance. So let's look at an example. So, our beginning balance is $10,000. We purchased equipment. That would have no effect on retained earnings because that would be part of what? Our balance sheet. We issued $20,000 in common stock. Had no effect. That would be part of equity. Paid salaries of $15,000. That would reduce our retained earnings because it would be part of net income. Earned revenue. That would increase retained earnings because that's part of net income. Paid rent. Decrease our retained earnings. Paid cash dividends, decrease our retained earnings. And now we have our ending balance at the end of the year of retained earnings. So that concludes this presentation. I hope that helped.